Hello guys, how's everyone? Hey, yesterday we talked about if you are planning to get into investment um, and investing in, be an investor. Um, so we covered a lot yesterday. As we promised that we will be talking about the financing, how to finance your investment properties. So let's get into it. So if you know that why real estate investment is a good idea, okay, and you want to get into it um, and start getting into real estate investments. So I think it's better that you learn it thoroughly, right? But before we even get into, into the nitty gritty details of each investing methods, um, excuse me, let's address the elephant in the room. Okay, to make money, you need to have money to invest, right? Well, yes and no. So while you do need money to invest, it doesn't necessarily need to be your, from your own savings, right? Because, you know, if we are only reference to those, real estate shows, house flipping TV shows, right? You might assume that real estate investing is all about cash buying, right? So there are many investment deals that transpire throughout the real estate market on an annual basis. Okay, the majority are achieved through traditional lenders, right? Institutes such as banks, your credit unions, lenders, right? But some are accomplished through less traditional means. In most cases, it's because the investor couldn't raise the capital, okay, or didn't have the credit score to do so. Okay, according to 2017 NAR Investment and Vacation Home Buyer Survey, 47% of investor finance less than 70%. Can you imagine that? And more than half, like 64%, used a mortgage. So whether you are reading, watching those shows, or you are a newbie, or you are a, excuse me, a seasoned pro, you shouldn't feel bad about that. Not even, you know, because if you don't have a cash, you say, okay, I'm definitely totally out of the game. So in fact, the ultimate goal for real estate investor is to not to, use their money by get the loan, or it works for actually every investor's advantage. Those without the funds can still get in the game, and people who've been playing for a while can use other, investment vehicles, and which leads to increased income, correct? So obviously, this is a bunch of people out there willing to get, hand over, right, their cash. So you can invest. This is when having a solid, backup, like knowing banks and your credit score, all those play an important factor in it. So you got to be clear on whom you can access for help, and how you can, use that when they give that away. So it's also to your advantage to have a high credit score, right? Like we talked about in previous lesson, that Why does this matter in this business? Because you get more access, right, to working capital, but you always also have, because of the good credit score, um, you'll be able to get lower interest rates. So if you take out the mortgage or a loan, okay, which can lead to significant savings versus people with so-so or low score, okay. So let's get the question, the main question, okay, Ruby, where should we get the money, right? Where to get the money from, right? Who's gonna give us if we don't have that option? So investing, you know, if you want to get into investment, and there are different options. The first and most common option most investors use is the private money lenders, right? So in this case, correct, um, people or business loan, okay, your money as an investment for themselves. So they make money through, fee and interest rates, or through fees, both of which tend to be higher than other type of loans, correct? So one way to make sure you still come out ahead, right? That's the one way to make sure uh, that the deal is that you're making, to use these loans to buy homes at 50 cents on dollar. Okay. So party partnerships are another popular way to get funding. These can work in a variety of ways, but you want to make sure that you balance each other out well. Okay. For example, all right. For example, if you have less than seller credit score, make sure your partner has a great one, because you can get into a partnership with another investor who has a great credit score, correct? Right? So this way, you can balance things out. So perhaps you can be the one, you find the deals or you find the properties, and your partner can get the financing. So it's a win-win situation, which will come with the lower fees and rates thanks to the higher score. So keep in mind though that you don't want to partner with someone who, just because you already have a good relationship with them, but the key to fantastic partnership is being in sync, such as, agreeing on the kind of risk you're willing to take, determine what short and long-term goals you both have, and figuring out who will do what, and deciding what kind of return you will get on your investment. So if you're planning to invest with your own money, and if you don't have access to, suppose, private lenders or partners, or who can still start your investing career, right, without having all the money, you know, on hand. So one way to do this without paying any money upfront is through home equity. Okay. You can use this by taking out some home equity line of credit, which leaves the mortgage as is. Okay. You need to talk to your lender about that and make sure they explain it to you thoroughly what home equity is. Okay. Don't just jump into it, and, but make sure that you have all your ducks in the row and you understand definitely about borrowing home equity loan from your home, okay, or rewriting your mortgage or getting out the cash out refinance, all that work, but that's only if you currently own your own property and there is a equity in it and there's a capital in it. And again, guys, make sure that you understand that if you're taking out money from your home, what kind of interest rate, what kind of loan it is, what kind of home equity it is, how long you have to pay, if it's going to change. Because the reason I'm trying to emphasize on this point is that this is the reason it happened in 2008 and 7 and 8, when people did took out the loans from their house and market crash. So be careful, okay, and make sure you understand when you're trying to borrow money from your own um, house, right, or home equity loan. So another route is a lease option. Okay, that's also called they call it option to buy. Okay, people ask me, Ruby, can you explain it to what is lease option, because they hear it from other people, and so lease option is that's option to buy. In this situation, that you would rent the property, okay, but sign an option to buy at a later date for an agreed upon price. Okay, this legally bind path to property ownership might take a little longer, but it's still a viable option if you have the funds, right? So that's also, you have to make sure that you talk to your attorney, your CPA, before you sign any documents for lease option with the homeowner. Okay, so again, seller finance, that's also almost just getting a loan through a bank. That's another option. So except you agree to the payback and terms directly with the seller, this loan should include a repayment schedule, interest rate, any consequences, right, that you both agree, the seller and yourself, and you should either party default on their agreement. Often these agreements include a significant down payment. Okay, they want to make sure they have a big chunk of down payment, sometimes higher than a mortgage. So many of these agreements are involve um, the seller holding on the deed until the buyer has completed all the payments, correct? Then the property will be transferred to your name. So that's an option, but that may or may not work for you. Okay. Um, you can also, there's another option that you can think about is investing into your own retirement funds, right? This typically doesn't work for people over age 60 because of the time frame, right? For the rental income to pay off the whole mortgage, correct? Because usually the mortgages are 30, 40 year, right? So if you are in that time age and time frame, it is kind of, seller might not agree to I'm sorry, not seller. Um, the retirement, the investing funds might not work. Okay. Um, so there's a sweet spot, like age wise. So around, people who are in their 30s or their 40s, right? It might work. It's work for them, might work for them, because people this age have theoretically been paying into retirement account for about a decade and might have fair amount of to spend, right? Also, there's a time to get a good return to them. So perhaps the mortgage will be paid off in 10 years. The net income after operating costs and you know, uh, it might work for that age range. So your retirement account can be used for purchasing and maintaining properties, or as well as collecting rents. However, none of the money can go directly to you. Okay. You need to keep that in mind because until you reach the age when you start withdrawing money out of your account, well, you technically can withdraw in many cases, but if you are younger than legally allowed age for withdrawal from your retirement account, there might be a significant penalty. So this could meaning losing thousands of dollars depending on how much you take out. So there's another vehicle is self-directed IRA. Okay, that's called, they usually call it in finance world is called SDIRA. Okay, that's called self-directed IRA. It's a traditional or Roth IRA, right? That's an individual retirement. That's why it's called self-directed, because it's an individual retirement account. Okay. So that allow you to invest beyond the usual mutual funds, stocks, etc. Okay. With self-directed IRAs, okay, SDIRA, you can invest in precious metal, tax liens, certificates, and whatever you like, okay, for the purpose here. Like here you are, we're talking about real estate, so you can invest in that. When you use your IRA to buy real estate, there are some important things to keep in mind. First, you are required to report the value of your investment to your IRA, custodians every year. Also, the fee structure can be complicated. So you need to understand that you will allow and how that is related to your overall profit. Okay. Also, your investment needs to bring it to, there's enough money to pay for both regular maintenance and any expenses that comes up. So without having to add any cash into it. Okay. So the majority benefit of using self-directed IRA for your real estate investment comes down to taxes. Don't, don't forget that. Don't forget that. Okay. We all know that. Uncle Sam, he gets us. You know that. Okay. So with traditional IRAs, it's tax deferred income, right? But with Roth IRA, your gains are tax free. And the money will also be a tax free when you ultimately withdraw it. Okay. If you go this route, you can move funds around from multiple projects without affecting your taxes. So, but keep in mind that tax and another financial laws can change any time, right? So make sure you keep on top of any changes, any laws, okay, and make any adjustment as needed. Okay. This is we are talking about the tax and laws, tax laws. Okay. So one tax downside is that if your property has a net loss, okay, you don't get a tax break. like other investors get. Okay. So you also can't claim any depreciation, correct? Another advantage of real estate over traditional retirement account is the return. Real estate uh, can net you perhaps like around 18 to 20% return over 30 years, right? Depends on the market. Where more common account IRAs like 401k, etc., they might only give you 3 to 6% in return, right? So not only that, but you okay, you can also use compound to your advantage. Okay? If you keep investing your money for first like 20 years, you can leave it for the last like 10 years, just let it grow, correct? But doesn't doing almost nothing will still make plenty of money, you know? That sounds great, but we're talking about, we're not talking about the TV shows here, reality. We're talking about the reality of life, okay? So as with investment, there are risks to using the SDIRA, like self-directed IRA. So you might make a bad decision of get scammed, or common is SEC has it's like a investor alert. So make sure, guys, make sure you check everything. You talk to your attorney, you talk to your lawyer, you talk to your CPA. This is you're planning to do. Don't just, pull out the money and give it to someone. Okay. Because as I said, there are good people, but there are bad peoples also. Okay. They, you know, this is life. So that's why I'm trying to make you guys aware that it happens. Okay. So, don't get burned. So other risks include not having enough diversity in your investment is hard when you have limited funds, right? And potentially not being able to access the money. Even once you are retired due to liquidity issue, okay? So this means you might not be able to take out the required minimum distribution. Again, this is why diversification is important. Okay, you need to have enough cash and credit to meet all the requirements. So speaking of following the rules, it's vital that you know them. Okay, you know the rules, you know the laws. Okay. So if you do something wrong, or you might accidentally disqualify the IRA, which means you will owe taxes, guys. Okay. So just make sure before you pull out any money from your retirement accounts, you talk to your CPA, your attorney, your lawyer, your accountant. Talk to them first, okay? That this is what you're planning to do, and um, and this is if this is the right path. So this also include not purchasing property for yourself. Um, there's also some laws behind it that you cannot purchase property for yourself or your immediate family member. Okay, that's the rule. Um, the self-directed IRA has. Okay, you cannot buy property from them, or you cannot sell property to them. Okay, but there are many other more rules as well. Okay, so you have to make sure before, as I said, before you pull out any money, you check everything first. Okay, so tax benefits for real estate investor, because both federal change and state law, local taxes can vary. So there's no specific guidance. I can, give about like the please, okay, please understand that tax ramification of any kind of real estate investing will depend on your particular location, any circumstances, okay, and as well as annual changes in the tax code. So I strongly recommended that you consult. Again, you guys gonna say, Ruby, why are you telling us over and over? Guys, I'm just trying to make you guys aware that make sure you consult with your CPA about the tax or tax attorney before beginning into any real estate transaction uh, or investment. Okay. So with, excuse me, with that side, at the time that, when general tax related benefits or real estate investors um, benefits, okay, you make sure that first you, that has to do with all the deductions of real estate investors can get. Okay, you can get, the deduction on your mortgage interest rate. You can get your business expenses such as property management, your office, your mileage, your travel, your education events, right? um, and then any repairs, any improvements that you are making to increase your property value. So all of these can be immediately deducted with the exception of improvement, which are like depreciated over time. Okay. So depreciation of the property itself, regardless of any work done, is also a tax deduction, and it's not over the course of time. Commercial properties can depreciate over a longer time than residential, currently like 39 years versus I think it's about 27 or 27.5 years, like that. Okay. But the land on which the property resides, that never depreciate. Okay. So you have to remember that. So if you rent out the property, sometime depreciation can get you a phantom gain. Here's like on paper, the number looks like loss. However, because the depreciation amount, right, you actually come out ahead on that. Okay, because the um like we talked earlier, the land is never depreciate. Okay, so a tax attorney or a, where your property is residing, that's what we're talking about on that land. So a tax attorney or CPA can help you figure out, all that numbers in your situation. So let's, another question mostly people ask, when I recommend them, guys, why don't you do 1031 exchange? Because that will save you tons of money. Okay, Ruby, what's 1031 exchange? Okay. Well, 1031 exchange, it actually, it allows you to put off paying any capital gains, right? Taxes. We're talking about taxes still. Okay, guys. Um, and we're talking about on the investment property, not the residential investment property. Um, any capital gains if you use your profit from a real estate sale to buy another property. So this makes your income, you know, essentially like tax free, right? Because the profit you make from the sale of your property, you're buying with that profit, you're buying another property. That's called 1031 exchange, and it is only, remember that, not in residential, not in on your own home. Okay, it's only on your investment property or properties. Okay, so because you can use that over and over, so because it makes your income essentially tax free, and you can pull all your profits and you can purchase the next property. Okay, but make sure there's a rule in that too. The rule is that you are trading up. It has to be equal or higher value, correct? Because the 1031 exchange, it covers only like business or investment properties, right? That if you're selling your investment property, you are, trading it up. Okay. So usually like it comes, I mean, it's mostly in beneficial in like if you have a vacation home or if you have a second home, it's not going to qualify. Okay. But you should check with your tax expert on that. Again, I'm saying that, okay, to see if there's any exception in your state, because every state have different laws, different regulations. So you have to check in your state, in your tax attorney, with your tax attorney, okay, with your CPA, correct? So there are like usually three specific requirements to qualify for 1031 exchange, okay? And you must meet all of them in order to qualify for that 1031 exchange. If you don't meet them, no, sorry, you are not qualified for it. You're not gonna get 1031 exchange or any tax benefits. Okay. Number one, like I shared with you guys briefly before, it has to be like a kind exchange. You cannot buy, um, investment property and then you're gonna go buy a business. No, it has to be property to for property. The property it must be similar or it must be similar to the one you sold. The purchase price of new property must be either the same, okay, or more than the one you sold. Okay. There's no switching from like, you cannot like, all right, right now I sold my commercial property and now I'm going to get into, residential 1031 exchange. No, that rule doesn't apply. Okay. Or vice versa. You sold your residential property and then you're planning to get into business, a commercial, right? But there's one exception. You can often like exchange a property and a land. Okay. So that you can do it. Time restrictions on that is you must qualify record, uh, identify a new property within 45 days of selling your old property. Within 45 days. Keep in mind, okay? So there are different ways to identify replacement properties. Number one, um, you have to find like, not have to, but find three properties, okay? Not worrying about their fair market value or anything like that. Um, Identify as many properties as you can as long as there's a aggregate fair market value is less than 200% that of the sold property on the date of transfer. If the above two rules are exceeded, you can buy 95% of the aggregate fair market value of the identified properties. Okay, let me say that again. First of all, time restrictions comes in 1031 exchange, right? You have to find it in within 45 days of selling your old one. You have to, find 3 properties, but don't worry about, their what is their market value or anything. These are the guidelines we are talking about for 1031 exchange. And then identify as many properties as you can, as long as there's a aggregate fair market value is less than 200% that of the sold property on the date of transfer. Okay. If the above two rules are exceeded, you can buy 95% of the aggregate market value of identified property. You also have to close the new property within 180 days of the previous property sale. Within 180 days of the previous property of the sale. Okay. A qualified intermediate, not only can you not directly responsible for the transactions or money, your intermediary must be someone with whom you haven't worked for at least 2 years. Let's use the example from like March 2019. The Motley Fool conducted with Thomas Casley. He said that let's say you have a property you bought for 100,000. 10 years pass and now it's worth 150,000. Okay. You have a 50,000 capital gain. Break it up in between capital gain and depreciation. Recapture however you want. You're still going to have pay taxes on that 50,000 you gained. So when you pay tax on that 50,000 of capital gain, because it was 100, now it's 150, you're going to have less money you can reinvest because you have to pay taxes, right? What a 1031 allow you to do is to invest that entire amount so you are not paying the taxes today and you can purchase a larger property, right? That's what 1031 is, the equal or above value property you can purchase, right? Well, we talked about that earlier. So that's what 1031 does. 1031, it allows you to do is invest the entire amount. So you're not paying taxes today and you can purchase the larger property. You could continue purchase larger um, properties and continue to use the 1031 exchange pretty much forever. You can just keep moving up. It has to be equal or more value. And if you really wanted to, I'm just going to be honest here, okay? Let me explain that to you. It's actually easier said than done. You can eventually leave the property to your heirs and and they will receive that property at fair market value on the date of your death by eliminating all of this capital uh, gains, depreciation, recapture that you should have paid during your lifetime. In theory, you can just keep purchasing larger properties, making more and more cash flow, but never actually paying any taxes on the property. In the interview of opportunity funds with Casley, a new way to possibly put off completely eliminate capital gain. Opportunity funds are a way to invest in opportunity zone, which low income communities governments have identified and Treasury has approached. The funds come with investors, including the ability to defer capital gains on a variety of capital assets. These include not just real estate, but also stocks, bonds, um, and more investment funds. Your CPA, your attorney, um, your accountant can give you all these specifics. So the time actually make sure 180. Remember that number because timeline has to be within 180 rollover as the 1031 exchange. But you are only required to roll over the capital gains, which means you are free to do what you want to do with your money. You want to do with your investment. Okay. So Castle actually is gave you run around for the number if it's for example if you hold the capital gain in the fund for 5 years you are going to receive 10% stepped up basis in the gain. Okay. Let's just like for example let's just say that you have 100,000 capital gain and in 5 years you receive 10% step up, you're only going to pay tax on 90,000 of that capital gain. If you hold it for another 22 years, for a total of 7 years, it's going to step up an additional 5% for a total of 15%, and you'll only pay tax on 85,000 of that gain. So now, if you hold that investment in the funds of 10 years, your investment is actual fund itself with the tax exempt. Just say that 100,000 you put into the fund. 10 years from now, it's worth 150,000. That 50,000 capital gain is completely exempt from the tax. Now, this is a little longer term play. Okay. We talk about 10 years. Okay. It's still a long time. This is a little longer term because you have to keep your money in there for at least 5 years to see any benefits from it. So I think there's over 7 trillion or some crazy number of appreciated gains in the United States. So all of those appreciated gains are technically eligible for the opportunity funds. And I think the background behind this is that they want to take those appreciated assets and move them into low income communities that need renovations and raise the status of those communities and opportunity zones. Opportunity funds are the way to do it. Castle pointed out one important aspect of opportunity funds for investors to keep in mind. Okay. So because of the requirement to have an opportunity funds, you had to be substantially improve these assets, which means doubling the property's basis. Essentially, it's building a basis, but just think about it. I guess for this purpose, the purchase price. You have to add as much as purchase price basically in capital improvement so it is substantial, or you have to develop the property from the group up and you have to hold it for 10 years, right? Okay, hope this helps. So now let's also talk about rental tax specifics. What are the rental property owners are open to? There are a variety of benefits which we talked about earlier, um, and some of them we'll talk about that again. You'll notice that several are the same as for the other real estate investment. Also, as with all properties, if you sell with a year of buying, you'll be taxed at your income rate. If you hold on a property for a year or more, as it usually is a case of rental properties, you'll deal with the capital tax gain, which is lower rate. So your overall tax deduction can depend on what type of investment business you have. If you are a sole you know, property owner, or if you're in partnership, or you are a corporate entity. Okay. And as always, do your research, okay, to make sure you are up to date and all the latest taxes laws. Make sure you talk to your attorney, your CPA, they can do the exchange for you. If you are ready to do that. So rental property tax, what are the benefits for that is like you can benefit for your home office supplies, your computer software, your mileage, your driving, your travel, your meals. Usually it's a 50% as long as you're having a business meeting while eating. Mortgage, unsecured loan, your credit card interest, your loan origination fees, your points, um, consider which kind of interest rate, uh, and utilities, your trash, recycling, uh, property tax, your licensing fee, um, occupancy taxes, insurance including liability, hazard, fires, sewer backup, flood, loss of income. Talk to your tax professional, your CPA. They have an umbrella of liability policy or a landlord liability policy. Okay. Maintain repair improvements and cleaning, your advertising, your commission to the agents, and how much money you paying them every time you buying or selling, your property managers, your who find our tenants and renew leases. This is considered part of marketing, property man also property management fees, property management salaries, their benefits. If you manage yourself, your business, your LLC, your corporation, you may be able to employ or have your salary be deducted. Homeowners Association fee, HOA. HOA requires such as specific for rent, signs, professional legal fees, including bookkeeping, filing, taxing, all legal work. So any losses incurred, up to 25,000 per year, anything over that can be carried over to next year. Note that your tax savings will be less than your loss. Your social security FICA, or sell if you are FICA, or if you are self-employment taxes benefit. So it can all range about 7.5 to 15.3 of your profit. Your second vacation home rented out for at least 2 weeks per year might allow you to write off advertising, rental commission, uh, prorate, or other expenses, right? For if you're renting it out as a vacation home. So some states have historic tax credit that include both the rental operation and any renovation. Your incentives from your state or locality to invest in lower income areas. Okay, they can give you, your state can give you the incentives for that, that you are investing into a lower income area. You also required to take a deduction for depreciation. So just know that when you sell a rental property, you're subject to depreciate recapture. Any gain that has to do with the depreciation is taxed at 25% or opposed to 20% for regular capital gain. The depreciation related gain is also called unrecaptured section, which is called 1250 gain. Okay. So one way to mitigate this is to always keep track of your passive activity losses. While they may not be deductible while you own the property, they are when you sell it. When what means that you owe, it will be less than what you owe. So by the way, if you're thinking, well, I just won't claim depreciation, then I'm sorry to tell you that this simply won't work. The IRS states that recapture's calculation is based on allowed or allowable depreciation, meaning that even if you didn't claim it, you still have to pay it. Let me say that again. The IRS states that recapture calculation is based on allowable and allowed depreciation, meaning that even if you didn't claim it, you still have to pay it. You might as well as get the deduction while you can and perhaps consider setting it aside for when you do end up selling the property. So hope all this help you guys, you learn about different vehicles, um, about, there's a 1031 exchange and the gain, capital gain, etc. So now let's talk about credit score. Okay. Um, Earlier we talked about that how higher credit score can get you a good interest rate. Credit score, as I briefly mentioned, that they can play an important role in getting financing and the rates you need to pay. I want to talk in details about that make up credit score, so you will know what you need to do should you want to improve it. First, your score is a number that tells lenders how likely you are to pay back the money. When you have a higher credit score, you'll get a better rates, right? And which leads to long-term saving and more money in your pocket. So credit scores are often based on the FICO score, which is, it can range from lowest being 300 and the highest is 850. The bad credit score is between 300 and 600. Poor credit score is between 600 to 649. Fair credit score is 650 to 699. Good credit score is 700 to 749, and the excellent credit score is between 750 and 850, which can get you amazing interest rate, okay, on your investment. So the determining factor and how much weight that vary between credit agency like uh, TransUnion, Experian, and Equifax. However, the following five are the major contributors to your score. What these companies, what they look for to see, to come up with your score. Your payment history, that plays 35%. your outstanding balances is 30%, your length of credit history is 15%, your type of account is 10%, um, and your credit inquiries is 10%. Okay. So by knowing your credit score, you'll have a clear picture of your investment strategies. If you score high enough, you might be able to get a traditional loan and help with down payments. If your score is lower than you like, um, take a look and determine what factors are playing and how you can improve that. You know how you making payments on time. You should clarify, that's your priority. You can also consider paying down balances as you're able and not opening up a bunch of new credit cards. Okay. But also be aware of the scams with so many people out there, looking to make money. Um, it's pretty much expected that there will be people out there, uh, they are ready to take advantage of other people, and that's the reason I'm bringing awareness out there, to guiding you guys, to bringing my years of experience, um, so you can learn, so you don't get, you know advantage, uh, don't get taken advantage from these, what we can say, bad people. There's a good people, there's a bad people, in this world. Okay. So the two main type of scams to watch out are the seminar scams and the lending scams. The seminar scams are, they can give some truly helpful tips, but also used as a way to gain people's trust. uh, Once they have a trust, they'll offer limited time investment properties or expensive classes. When people fall for that trick and buy a property, they often find that it's got a lot of issues, or it's quite likely a money pit. You're spending so much money, putting so much money into the property. Um, However, signing up for these classes can be negative too. Um, Reason is, you'll ask why, because people often end up spending thousands of dollars for little or no information, when that money and their time couldn't gone towards their investment, right? Uh, to make things even worse, people who get uh, taken in by these scammers, these, you know, often, they're signing agreements without reading them through. These documents often include a section that keep the scam people from taking legal actions against the scammers. Okay. Uh, so you have to watch out, and that's the reason, as I said, I'm trying to bring the awareness to you guys. Okay, so how do you find generally helpful seminar? Yes, they sometimes they do exist. Okay, but you have to do your own research. You look up the organization, you look up the presenter, the properties, the courses. Okay, who can also start by looking up certified experts or see if they offer any educational opportunities. Um, and here, that's the reason I'm bringing all this awareness free for you guys, just through my own experiences. Okay, been in real estate for a long time, and so I know what goes into these, uh, sometimes scammers, how they are using people, okay, for their own benefits. Um, so l- there's another scam. It's a lending scam. Okay, that's a common scam in real estate. It's fairly easy type of a scam for the investors to fall into. Okay, because often they are looking for alternative financing, right? That doesn't have to be the same qualification required by traditional financing. This kind of financing often has a requirement to pay back the money more quickly than tend to have higher interest rate than mortgage. Those things alone don't mean that they are scam though. But the problem is that lender don't have to be licensed to hand out money. So it can be a bit tricky to make sure the lenders are legit lenders. Okay. So that again, as I said, you have to do your homework, you have to do your research about that company. Um, talk to your attorney, talk to your CPA. How do you make sure that lenders you're working with is, you know, they are okay and they are up to speed? First, you find the lender through one of, uh, you can go to your local bank, or you can have somebody, if somebody referred to you or if they used that lender before, um, then definitely go ahead with it. But also you have to see that if there's any red flags in that. Okay, does a lender seem to know details about the investing? Do they lending including correct jargons? Is there a major upfront fee that you have to pay? Okay, does the lender seem a little too eager to give you money? Okay, if the other words, do they skip asking you essential questions? uh, get right down to the money talk, right? So these are the main factors that you should check into. Okay.